Welcome to Paisa Forever channel. Have you checked your investment portfolio lately? If you opened your investment app this week and saw a sea of red, with the Sensex down over 1,000 points and the Nifty dropping below 24,900, you are certainly not alone. A massive wealth erosion of over 6 lakh crore rupees just happened. Let us break this down. We are currently witnessing an unprecedented geopolitical shock in March 2026. The Iran versus Israel and USA conflict has fundamentally altered the global financial landscape. This is not just a localized skirmish anymore. We are seeing the war escalating to all Middle East, drawing in multiple nations and severely disrupting global supply chains. The stock market crashed due to this sudden escalation, leaving many Indian investors wondering how to protect their hard-earned money. Here's what this means for your portfolio. We are moving from a high-growth mindset to a capital preservation and strategic hedging mindset. Today, we'll explore exactly how you can shield your investments during this crisis. The first place investors run during global panic is the oldest safe haven in the entire financial world: precious metals. Today, the data shows that gold prices have skyrocketed, recently breaking the $5,350 mark internationally, while domestic MCX gold jumped significantly. Gold hedging during war is essential because gold operates independently of any single government currency or banking system. You can gain exposure through sovereign gold bonds, which give you a fixed 2.5% interest annually, or gold exchange-traded funds for higher liquidity. But wait, there is more to this. Silver hedging during war is equally critical. Silver prices hover around $93 internationally today, showing very strong market resilience globally. Silver possesses a unique dual nature. It is both a precious monetary metal and a crucial industrial component for solar energy and electronics. This dual demand makes silver a highly volatile but potentially rewarding hedge when global supply lines are threatened by the escalating conflict. Let us examine another excellent wealth protection strategy available today. Now here's the interesting part. While broader markets bleed, the defense sector often rallies. Military budgets are expanding globally. Let us look at defense stocks, ETFs, mutual funds for both Indian and international exposure. In India, companies like Hindustan Aeronautics Limited thrive today immensely. Bharat Electronics Limited and Mazagon Dock Shipbuilders have seen tremendous order books due to the government push for self-reliance. You can invest in domestic defense mutual funds like the HDFC Defense Fund or Motilal Oswal Nifty India Defense Index Fund. Internationally, looking at United States contractors through Global Defense Exchange Traded Funds offers exposure to the massive $900 billion defense budget. Are you looking for a modern alternative to traditional assets? Let us discuss crypto hedging during war. Bitcoin recently slipped to around $66,000 as the Middle East conflict sparked global market panic today. However, historically, decentralized assets can act as a hedge against fiat currency collapse. While highly volatile, a small allocation to Bitcoin or Ethereum provides a non-correlated asset class that is completely outside the traditional banking system. This brings us to equities now. With the broader market down, is this a time to panic or a time to buy? For long-term investors, adopting a buy-on-dips of index ETF strategy is historically one of the most effective ways to build wealth. Buying Nifty 50 exchange-traded funds on every 1 or 2% market dip allows you are essentially buying the top 50 companies of India at a discount. If you have a 10-year horizon, these geopolitical shocks often look like small blips on a long-term chart. Next, we must talk about energy. The Strait of Hormuz handles roughly 20% of global oil flows, and with the current conflict, it is under severe threat. Oil prices leaped instantly. Implementing oil stocks hedging during war is a strategic move. You can look at Indian oil exploration companies like ONGC or Oil India, which benefit from higher crude prices, unlike marketing companies that might suffer. Internationally, major United States or European oil conglomerates provide a direct hedge against soaring energy costs. Let us shift gears to stability. When equities are volatile, government bonds and fixed income securities become the bedrock of a resilient portfolio. The Indian 10-year government bond yield has been fluctuating around 6.68%. Sovereign debt provides guaranteed returns and strict capital protection. During a crisis, institutional money floods into these safe assets. But what about the currency risk? The Indian rupee often depreciates against the United States dollar during global crises due to rising oil import bills seen today. Currency hedging or USD exposure is absolutely vital here. You can achieve this by investing in international mutual funds that track the S&P 500 or the Nasdaq. Because these funds are denominated in dollars, when the dollar strengthens against the rupee, your portfolio value in rupee terms actually goes up, providing an automatic hedge against currency depreciation. These international investments provide a fantastic safety net for you. If you still want to stay invested in domestic equities, where is the safest place to hide? You should pivot towards defensive sectors like FMCG, pharma, and utilities right now. Fast-moving consumer goods companies, pharmaceutical giants, and utility providers are resilient because people will always need basic food, critical medicine, and electricity, regardless of whether there is a war in the Middle East. The nifty FMCG index might face short-term pressures, but fundamentally, consumer demand remains very steady. Finally, and perhaps most importantly, we need to discuss liquidity. Maintaining cash reserves or liquid funds or bank FDs is the ultimate hedge. Liquid mutual funds invest in short-term debt instruments and provide returns around 6 to 7% while allowing you to withdraw your money almost instantly anytime. Having a strong cash position means you're never forced to sell your stocks at a loss to meet an emergency expense, and it gives you the dry powder needed to deploy into the market when those attractive dips finally occur. So what is the ultimate takeaway for the Indian investor navigating this turbulent March 2026 landscape? War brings uncertainty, and uncertainty breeds market panic. But panic is the absolute enemy of wealth creation. By systematically diversifying across gold, silver, defense, energy, international assets, and maintaining solid cash reserves, you build an impenetrable fortress around your growing wealth. This is not about timing the market perfectly, it's about preparing your portfolio for multiple complex outcomes. Please remember, this video is strictly for informational and educational purposes only and does not constitute financial advice. Always consult with a registered financial advisor before making any investment decisions. If you found this detailed breakdown helpful, please hit that like button, subscribe to the channel for more global market perspectives, and let me know in the comments below which specific hedging strategy you are implementing right now. Stay safe, stay diversified, keep learning, and happy investing to all of you today.